Hi, I'm Michael Taila, Director of Fixed Income at City National Rochdale, and welcome to this month's edition of Fixed Income Perspectives. Although it's been 2 weeks since we wrapped up the first quarter, it seems more distant as market volatility is keeping investors busy navigating an uncertain trade policy landscape. The quick changes in sentiment over the past few days have refocused attention away from the solid performance of most fixed income asset classes in the first quarter. To recap, January and February benefited from declining rates and strong investor demand. That gave way to a weaker March as economic and tariff risks became more pronounced. U.S. Treasuries posted strong returns near 3%, while investment-grade corporates and high-yield emerging market debt closely followed with around 2.3%. Even though investment-grade municipals were slightly negative, the decline in prices has created compelling income opportunities that should persist for some time. As the second quarter gets underway, elevated volatility across most asset classes is reminiscent of the great financial crisis of 2008. The unexpected changes in trade policy are a primary driver, with President Trump's Liberation Day resulting in steeper tariffs than what was initially expected by investors. Market reaction was sharply negative across most asset classes, with the S&P 500 declining by as much as 12%. However, after pausing most tariffs for 90 days, apart from those with China, the tone of the market has improved, but the tension between the US and China is likely going to continue to be disruptive to global financial markets. The lack of clarity surrounding policy direction has led US Treasuries to trade in historically wide intraday ranges. 10-year and 30-year Treasury bonds have been as wide as 70 basis points, a level last observed during the early days of the pandemic. For example, after reaching a low of 4% in early April, the 10-year U.S. Treasury increased about 50 basis points within a few days. Speculation surrounding these abrupt moves in Treasury rates has been attributed to several factors, such as deleveraging and diminished foreign buyer support. In our view, recent movements in Treasury rates reflect the interplay between domestic policy decisions and broader economic concerns surrounding inflation and projected federal deficits. These themes will play out in the coming weeks and months, and they will impact the credit markets unevenly, especially if the economic growth forecasts become less clear. Over the past few weeks, credit spreads for investment-grade and high-yield U.S. corporate bonds have widened from their multi-year lows, but they have recently found a more stable footing. For instance, investment-grade and high-yield U.S. corporate spreads peaked at 120 and 455 basis points, but now they are trading somewhat tighter. Since early March, both investment-grade and high-yield mutual funds have reported volatility-induced redemptions on a scale last observed as early as 2023. But while outflows ordinarily lead to spread widening, corporate credit quality remains intact with healthy balance sheets and manageable leverage. As corporate earnings season gets underway, we are carefully monitoring how near-term guidance is changing to the uncertainty of trade policy. In municipals, the change in benchmark yields has been eye-catching, with bonds repricing higher by as much as 100 basis points across the curve over a 3-day period. However, this sharp move was not credit-related, but a technical event where liquidity needs from ETFs and other sellers disrupted the market. In fact, municipal bond credit quality spreads have remained somewhat range-bound since the beginning of the year. But the underperformance of municipals versus U.S. Treasuries has resulted in valuations exceeding their 5-year historical averages, with available yields now offering a more compelling entry point for long-term investors. In closing, policy-induced market volatility is likely to continue. We anticipate regulatory and tax reform to gain more bandwidth as the House and Senate deliberate proposals in the coming weeks and months. For more than a year, we have held the view that rates will remain structurally higher for longer and forecast the 10-year Treasury to remain range-bound between 4 and 4.5%. We think the Fed is likely to remain patient as it awaits data on how current trade policy decisions may impact inflation and labor market strength. However, we do anticipate 1 to 2 rate cuts by year-end. Thank you for watching, and please reach out if you have any questions.